Hello everyone, welcome back to the channel. Today I want to focus on what I think is one of the most interesting contradictions in global markets right now. Wall Street is trading near record highs. The S&P 500 has just completed its third consecutive weekly gain, its longest winning streak since May. Yet, at almost exactly the same time, we are receiving increasingly clear signals that the American consumer may be starting to lose momentum. So the question I want to answer today is very simple. If the US economy is slowing, why is the stock market still near record highs? And more importantly, is this rally healthy, or are investors walking into a trap? Before I begin, a quick reminder. Nothing I discuss in this video should be considered investment advice. I am simply sharing my own market interpretation, the technical levels I am following, and the scenarios I think investors should monitor. Let me start with the market itself. The S&P 500 finished the latest session down around 0.2% at 7,785.76. The Nasdaq 100 slipped approximately 0.1%, while the Dow Jones Industrial Average fell 0.2% to 53,732.41. The MSCI World Index also declined slightly. On the surface, therefore, it was a weak day, but I think looking only at the daily move would be misleading. The much more important point is that the S&P 500 still managed to complete its third consecutive positive week. The broader trend remains strong, and the index is trading very close to its historical highs. That strength becomes much more interesting when I compare it with the latest data coming from the American consumer. The preliminary University of Michigan Consumer Sentiment Index for August fell to 51, significantly below the consensus expectation of 55. At the same time, July retail sales recorded their sharpest decline in more than a year. These are not insignificant signals. The US economy is heavily dependent on household consumption. When consumers become less confident and spending starts to lose momentum, I pay close attention because this can eventually translate into slower corporate revenue growth, weaker earnings momentum, and softer overall economic activity. But there is an important qualification here. Some analysts argue that Amazon's Prime Day timing may have distorted the retail sales data. Prime Day was moved from July last year to June this year, which may have pulled some spending forward. I think this is an important detail because I never like to build an entire macroeconomic thesis around one data point. Still, when weaker retail spending appears alongside deteriorating consumer confidence, I think the message deserves attention. And this brings us to the central paradox of the market. Normally, weaker consumption and slowing economic activity should be negative for equities, yet the market is not reacting that way. Why? Because financial markets do not price economic data in isolation. They price what that economic data could mean for interest rates. And right now, weaker consumer confidence and softer spending are reducing fears that the Federal Reserve will need to tighten monetary policy further in the near term. The market is increasingly assigning greater probability to the Fed keeping interest rates unchanged at its September meeting. This is extremely important. A slower economy is fundamentally negative for corporate earnings. But if that slowdown reduces the probability of higher interest rates, equity investors may initially interpret the same economic weakness positively. This is what I call the bad news can be good news phase of the market cycle. The problem is that this relationship has limits. A moderate slowdown can be positive because it reduces inflationary pressure without destroying earnings. But if the slowdown becomes too severe, the market eventually stops focusing on lower rates and starts focusing on weaker profits. That transition is where equity markets can become vulnerable. And this is exactly why I think the next several weeks are going to be particularly important. Chicago Fed President Austin Goolsbee said that he was encouraged by the recent slowdown in inflation, but he also made clear that he wants to see that improvement continue before declaring victory over the Federal Reserve's 2% inflation target. I think this tells us something important. The Fed may be becoming more comfortable with the inflation trajectory, but policymakers are not yet signaling that the job is finished. That means the market still has to navigate a very narrow path. Growth must slow enough to reduce inflationary pressure, but not so much that corporate earnings deteriorate materially. Inflation must continue moving in the right direction, but without forcing the Fed to maintain restrictive policy for longer than markets expect. That is the soft landing scenario. And in my view, the S&P 500 is currently priced much closer to that optimistic scenario than to a recessionary one. There is another important piece of information that makes the situation even more interesting. The US 10-year Treasury yield actually rose by around 4 basis points to 4.68%. This catches my attention. If the market were completely convinced that weaker consumer data would lead to easier monetary policy, I would normally expect stronger demand for government bonds and downward pressure on yields. Instead, the 10-year yield moved higher. So I see a subtle disagreement between different parts of the financial market. Equity investors appear comfortable with the soft landing narrative. The bond market is not giving quite the same message. I am not saying that one market must be right and the other wrong, but when stocks are close to record highs while long-term yields remain elevated, I become more selective about risk. Higher long-term yields increase the discount rate applied to future corporate cash flows. That matters particularly for expensive growth companies whose valuations depend heavily on earnings expected many years into the future. So even if the Fed does not raise rates, a 10-year Treasury yield near 4.7% is not exactly a loose financial environment. This is one of the reasons I do not want to look at the S&P 500 chart and simply conclude that because prices are rising, risk has disappeared. Now let me move to the technical picture, because this is where I think the situation becomes much clearer. On the daily S&P 500 chart, the trend is still decisively bullish. The index has recovered strongly from the correction toward the 6,500 region in April and has since developed a consistent sequence of higher prices, eventually reaching the current record zone around 7,789. The moving average structure is particularly strong. The price is above the 14-day moving average, which is around 7,669. That 14-day average is above the 50-day moving average at approximately 7,520, and the 50-day moving average remains comfortably above the 200-day moving average, currently around 7,089. For me, this is a textbook bullish alignment. Price above the short-term average above the medium-term average above the long-term average. This is not what a technically weak market normally looks like. It tells me that the primary trend remains upward until the market gives us evidence to the contrary. The next important level is around 7,793. That is effectively the immediate record high resistance area. If the S&P 500 can break that region convincingly and maintain its position above it, I think the psychological 8,000 level becomes the natural next reference point. I want to emphasize the word psychological. Markets often react around large, round numbers because investors naturally anchor expectations around them. So 8,000 is not important because there is something magical about the number itself. It is important because many market participants are watching it. Now, there is one potential concern on the daily chart. The stochastic momentum index is around 86.6 and 84.3, which places it firmly in overbought territory. Some investors see an overbought indicator and immediately interpret it as a sell signal. I do not. In a strong trend, markets can remain overbought for a surprisingly long period. What matters more to me is whether momentum confirms the price action. At the moment, the S&P 500 is making new highs while momentum remains strong. I do not see a clear negative divergence in the data I am analyzing. So for now, I interpret the overbought condition more as evidence of strong momentum than as proof that a reversal is imminent. That said, I would not personally want to chase the market aggressively at record levels. There is an important difference between believing that the trend remains bullish and believing that every price is an attractive entry price. Those are not the same thing. For me, the first important daily support is the 7,669 area where the 14-day moving average is located. If we get a normal correction toward this level and buyers return, I would consider that constructive. The more important support sits around 7,520, close to the 50-day moving average. As long as the market remains above that area, I would still describe the larger technical structure as bullish. If we move below 7,520 and start closing beneath it consistently, then I would become much more cautious because that would suggest that the correction is no longer simply a short-term pause within an uptrend. The 4-hour chart tells a similar story but gives me more precise short-term levels. The immediate resistance remains around 7,793, followed by approximately 7,900. On the downside, I am watching 7,784 and then 7,755. The index recently broke above a multi-month consolidation zone that had roughly contained the market between the 7,550 and 7,800 areas. That breakout is important. When a market spends months moving sideways and then breaks upward, the old resistance zone often becomes the first area where buyers try to defend the new trend. So I am paying particular attention to the 7,755 to 7,784 region. If the index pulls back into that zone and holds, I would interpret it as evidence that the breakout remains intact. If it falls decisively below that zone and returns to the previous consolidation range, then I would start questioning the strength of the breakout. This brings me to my first scenario. Scenario 1 is the bullish continuation scenario. In this case, the US economy slows gradually but avoids a sharp contraction. Inflation continues to moderate. The Fed remains patient. Long-term yields stop rising materially. Corporate earnings remain resilient. Under that scenario, I would expect the S&P 500 to break above 7,793 and eventually challenge 7,900 and then 8,000. Technically, this is currently the scenario supported by the prevailing trend, but I would still want to see price confirmation rather than assuming it will happen. My second scenario is what I would call the healthy correction scenario. The index fails temporarily around its record highs and retreats towards 7,669. Momentum cools, the market becomes less overbought, but buyers defend the rising moving averages. In my view, this would not necessarily be bearish. In fact, after such a strong rally, some consolidation could actually improve the technical structure by allowing price and moving averages to reconnect. Markets do not need to rise every day to remain in an uptrend. Sometimes a controlled correction is exactly what keeps a longer-term trend healthy. Then there is the third scenario, and this is the one I think investors should respect. The economic slowdown becomes more pronounced. Consumer weakness starts showing up in company guidance and earnings estimates. Long-term Treasury yields remain high despite weaker growth. The market begins to realize that easier Fed policy may not be enough to offset deteriorating fundamentals. Under that scenario, I would focus first on 7,669 and then, much more importantly, on 7,520. A decisive break below the 50-day moving average would tell me that the market's character may be changing. That would not automatically mean a bear market, but it would tell me that risk management should take priority over optimism. And this is where I think many investors make a mistake. They try to predict whether the market will rise or fall instead of defining what information would make them change their view. I prefer the second approach. Right now, I see a bullish trend. I also see an overbought market. I see weakening consumer indicators. I see expectations for a more patient Federal Reserve. And at the same time, I see a US 10-year Treasury yield at 4.68%. These signals are not perfectly aligned. That is why I do not think this is the moment for extreme confidence in either direction. If the S&P 500 breaks through 7,793 with strong momentum, I respect the trend. If it pulls back but holds 7,669, I still respect the trend. If it breaks 7,520 decisively, then I reassess the trend. This is the framework I use. I do not need to know today exactly where the S&P 500 will trade 1 month from now. I need to know which levels would confirm or invalidate my current interpretation. And I think that distinction is extremely important for disciplined investing. So, is this rally a trap? Based on the current technical structure, I cannot call it a trap yet. The trend remains bullish, the moving averages are positively aligned, and momentum is still confirming the record high price action. But I also do not think this is a market where investors should ignore the macroeconomic warning signs simply because the index is rising. The American consumer is beginning to show signs of weakness. Long-term interest rates remain elevated. The market is depending heavily on a soft landing narrative, and when an index is already close to record highs, the margin for disappointment becomes smaller. For me, the key levels are therefore very clear. 7,793 is the immediate breakout level. Above it, I watch 7,900 and then 8,000. On the downside, 7,669 is my first important support, and 7,520 is the level that would make me reconsider the strength of the broader trend. I will continue to watch those levels together with consumer data, inflation, Fed communication, and the US 10-year Treasury yield, because markets rarely turn because of one number alone. They turn when the relationship between growth, inflation, interest rates, earnings, and investor expectations begins to change. And right now, that relationship is becoming increasingly interesting. If you found this analysis useful, you can subscribe to the channel and follow my upcoming market updates. I will continue to focus on the data, the charts, and the scenarios rather than trying to predict headlines. Because in markets, I believe discipline is more valuable than certainty. See you in the next video.